Hey guys, what's up? I'm Erin and welcome back to the channel. Dave Ramsey, a man who needs no introduction. He's an absolute legend, but he does make some pretty bold claims when it comes to expected investment returns. According to Mr. Ramsey, you can expect a 12% return on your investments. As you can imagine, this number is shockingly high to many people, especially those financial professionals out there, or even us financial nerds. But hey, I wear my financial nerd badge with pride because sometimes you just have to own who you are. Many say that number is just too high. It's unrealistic and not achievable over the long term. And this isn't anything new. He's been using that number for well over a decade. But no matter what others say, Dave adamantly defends his stance on 12%. So the question is, how realistic is 12%? You probably know Dave Ramsey has a YouTube channel here and he's got probably thousands of videos listed. And I love watching them. I love hearing about people's financial journeys. I work from home, so I generally have YouTube playing in the background or audiobooks, but I love Dave Ramsey's channel especially because I get to hear about those personal stories. And that to me is what makes finance fun. Now, the first time I actually heard Dave say that 12% number, my ears perked up and I was like, well, that's high, but he probably just said the wrong number. Then several videos later, I heard that 12% again and I'm like, okay, well, clearly not a mistake. It does seem aggressive, but didn't really faze me too much because I'm like, what does the next person have to say about their money journey? What's going on in their life? So I just moved on to the next video. Fast forward to last week, I hear that 12% number again, and this time it hits me a little bit different. This time I heard it and thought, are there really funds out there that are getting a 12% return over the long term? Maybe I should do some digging and find out. So Dave says that he's invested in several mutual funds that have netted him an average annual return of 12%. Upon digging, I haven't been able to find the exact funds he's invested in. I don't think he's ever said. I could be wrong, but I wasn't able to find it. But he is a very outspoken and passionate investor in mutual funds. And as he states himself, he's an aggressive investor. He's not a fan of bonds, which is good for our purposes here if you're chasing those higher returns. And he says that his ideal portfolio would look something like this. It would be based in mutual funds with 25% to international, 25% to growth and income, 25% to aggressive growth, and 25% to growth. As you can see here, the focus is on growth and trying to capture those higher returns. And there's absolutely nothing wrong with that. But just keep in mind that this type of portfolio is going to experience greater volatility as it tries to capture those greater returns. It's important to note that every investor has a different risk tolerance. And if this is a portfolio you're interested in, you're going to have to know it's going to require a bit of a stronger stomach because inherently it will have greater volatility. Dave says that he bases his 12% expected return rate on the real and projected historical performance of the S&P 500. The S&P 500 was established in 1957, and from 1957 to 2021, the index has returned an average of 10.5% annually, which is crazy impressive, but still shy of 12%. But according to Team Ramsey over at Ramsey Solution, they have projected data back to 1920 as if that fund were in existence. And if you go back that far, apparently it gets closer to 12%. Further, if you take smaller segments of time, this post from the Ramsey website actually shows that there are time periods where the S&P 500 has actually exceeded that 12%. So let's see if we can do some digging and find some funds that have actually hit this 12% threshold or even surpassed it. My first go-to is going to be to checking those funds that track the S&P 500. As he said, that is what he's basing his number off of. So if we look at the Fidelity 500 index fund, we see that the 10-year average rate of return is 15.42%. That's incredible. Taking that projection out further, we see the fund has a lifetime average return of a little bit over 11%. It's not 12, but I'm not complaining. Who would complain about an 11% rate of return? That's amazing. And to be honest, it's kind of close to 12. Just to put into perspective how amazing an 11% rate of return is, that means your money would literally double every 6.5 years. Or to put it another way, if you invested $6,000 per year or $500 a month starting at the age of 25 and did that until you turned 65 and somehow captured this 11% annual return, you would retire with $4.2 million. That's why I said it's incredible. And while Dave Ramsey does say that his 12% figure is based on the historical returns of the S&P 500, his mutual fund recommendations don't limit him to simply S&P tracking funds. Remember, he recommends international, growth and income, aggressive growth, and growth funds. So let's go do some digging for some more mutual funds. First, we have the Fidelity Growth Company Fund, ticker symbol FDGRX. This growth fund has a 10-year average performance of 20.56% and a lifetime average return of 14.63%. Oh my goodness, man, to be invested in that fund. This fund was established in 1983, so it has been around for just shy of 40 years, and it does have a bit of a higher expense ratio than a traditional index fund, and the bad news, it's closed to new investors. What an incredible performance. I truly hope that there was some 20 or 25-year-old who started investing in this fund in the early 80s and just held it for their entire life and just did amazingly well. Imagine if they dollar cost average and invested and got 14% return every single year. Yes, I know an average annual return of 14% is not the exact same as 14% per year, but it's still incredible. Think there are more funds like that? Well, it turns out there is. How about another one from Fidelity? The Fidelity OTC portfolio, ticker symbol FOCPX. This fund primarily focuses on US-based companies with a small amount of international exposure. It has a 10-year average return of over 20% and a lifetime average annual return of 14.65% and has been around since 1984. It does have that slightly higher expense ratio as it is a managed fund, not an index fund, but the good news is it's open to new investors. Or the Fidelity Select Software and IT Services portfolio, ticker symbol FSCSX. It has a 10-year average annual return of 21.54% and a lifetime average annual return of 16.74%. If you had invested in this fund, your money would literally double every 4.5 years. This fund was established in 1985. If you had invested just $500 per month in this fund for the past 37 years, its entire existence, you would have a nest egg in the ballpark of $14.5 million. That is beyond phenomenal. So it really seems like Fidelity is stealing the spotlight right here, but are there other companies that have stellar performing funds like this? How about the Health Sciences Fund from T. Rowe Price, ticker symbol PRHSX? This fund has a 10-year average annual return of almost 21% and a lifetime annual return of over 15%. The fund was established in 1995, so it's a bit younger at 27 years. It is open to new investors and has an expense ratio of 0.76%. Again, keep in mind it is a managed fund, so it's going to be more expensive than an index fund. So what's the takeaway from all this? Well, apparently it is entirely possible to get that 12% return that Dave Ramsey talks about, maybe even more. Did I cherry pick funds for the purposes of this video? Absolutely. That's the point, to see if it was possible to get this type of return. And as they say, hindsight is 20/20. It's easy to look back over the years and say, wow, what a great performer. And I know a lot of us financial nerds at this point are kicking ourselves thinking, oh, if only I would have invested in these funds, think of where my money would be today. But here's some equally important statistics. Over a 3-year period, 67% of actively managed funds underperform the S&P 500. Over a 5-year period, 72.8% underperform the index. At 10 years, that stat is 83.2%. And at 20 years, that number is 86%. As of 2020, there are 7,636 mutual funds based in the US. Globally, there are exponentially more. So what that means is if you're trying to beat the market, you're going to have to select your funds very carefully and know that the odds are stacked against you. But of course, I would say something like that. I am an indexer at heart. I have no interest in beating the market. Well, I mean, I do have an interest. I would love a 12, 14, or 16% return, but I'm doubtful in my ability to actually successfully select these funds. So instead, I simply try to capture the market return by choosing index funds. Could you select one of these amazing performing funds that outpaces the market every single year? Absolutely. They are out there. But statistically speaking, you're more likely to select a fund that underperforms the market. And just because a fund beats the market one year, there's no guarantee that it will go on to do it in sequential years. Remember, there's generally a reversion to the mean. A lot of the times, I think he says 12% to get people excited about investing. He wants people to improve their financial status, and you can usually only do that by investing. If you say you can get a 12% return, that gets people excited and wanting to invest. Whereas if you say you could get a 4% return or some other lower number, you're likely not to be that excited. You might not get started investing. And also, it's important to remember that he says that he's getting a 12% return annually. So maybe he's just speaking about his personal situation when he cites this number. If you started investing in a year like 2021, you likely captured the market return of 27%. So go you. Can you expect a return like that going forward? No. Can you expect a return like that in occasional years? Yes, because the market does that occasionally, but it also has years where it goes down. It doesn't do 27% every single year. But you're far more likely to generate wealth if you invest. If you don't invest, you leave your money sitting on the sidelines in a savings account in cash, it's losing value at the rate of inflation. You have to invest. I personally like to use an 8% annual return when I do my projections. And there are plenty of people who come at me saying 8% is too aggressive, it's not realistic. Dave Ramsey likes to use a 12% number. What are you comfortable with? If you're more conservative, use 4, use 6. At the end of the day, none of these projections end up being correct anyhow. The point is just simply to make an estimate. If you're comfortable with a more aggressive approach, you will likely have a greater return. If you're a more conservative investor, you can expect a more modest return. And with all of the funds I presented here, and really any fund, you can look to see how they've performed over the past 10, 20, or 30 years. But just keep in mind, how they've performed in the past is no guarantee of how they will perform in the future. Past performance is no guarantee of future performance. Well, that's going to do it for me today, guys. What do you think about a 12% annual return? I would love to hear your thoughts down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of anyone who might get something out of this type of video, please consider sharing, as it really does help the channel and I really appreciate it. I hope you have a good one, and I'll see you next week. Bye.